Stand by for action. We are about to launch Bloke
Oh, hello. Right, well, I thought we needed to say something a little bit more about inflation because there's been a little bit of news on that recently. Because what you've probably noticed is that over the last decade, inflation was very, very low, almost non-existent, and loans were very, very cheap. And then all of a sudden, over the last few years, inflation has ramped up. There's lots of reasons behind that. One of the principal things that's changed, though, is in the last decade, we've had a very rapid move towards a highly globalised economy, which is enabled by rapidly advancing technology. So the speed of transactions has massively increased. And what are the implications of that for inflation? Well, as you know from the previous video that we did, which I know you dutifully watched, in the developed world, central banks have an inflation target in their mandate of around 2%, want a little bit of price increase on a regular basis. And they have to have various policies that they implement, raising and lowering interest rates, printing and reducing the money supply, collectively called monetary policy, that they use to pull the levers on the economy to influence inflation. Now, the problem with that is that the effect of monetary policy is very, very slow. Now that's fine if the pace of change and the speed of news flows is low. So the Bank of England, for example, was set up, I think in 1624, something like that. It was set up by King William at the time to finance fighting the French. So all good laudable reasons, obviously. Now at that time, it's the kind of time when the Mayflower has taken the Pilgrim Fathers over to Plymouth, from Plymouth. Can't quite work that one out, but apparently that journey took something like 66 days. So news flows from the colonies that the Bank of England would then have to act on, might take 3 months for that to happen. Now things are happening in fractions of a second, but we still have monetary policy levers that could take many months or years, in fact, to affect people. So the latest thinking is that we're probably going to have variable inflation targets managed by the central banks. So what does that mean? Well, it means that the central banks will raise and lower interest rates, increase and decrease the money supply to keep inflation somewhere maybe between 1% and 4%, rather than specifically trying to ratchet it at 2% with control levers that really aren't up to the task anymore. What are the implications of that? Well, if I was a mortgage lender and I knew that there was an upper range that inflation could go to and interest rates might increase, I might price my mortgages to be just that little bit more expensive at the top end. So I think we could expect lending rates to go up. The other thing is that inflation is linked to the risk-free returns that governments pay on their debts. It's a key metric on which portfolios are run. And also inflation is the thing that we're aiming to beat to increase the buying power of your money. This probably implies that we'd have to be a little bit more agile with our portfolio management, but also we'd have to make sure that they can work just a little bit harder to give you returns near the high end of the inflation targets. So a little bit speculative, but this is something that's coming and something we need to be ahead of. So let's be ahead of the curve rather than reacting to it. Now, that was said, that was something that came up in the news today. There's lots and lots going on in the news at the moment. Very difficult to keep up with that because it's all happening very, very quickly all over the world at the moment. But we obviously have our regular briefings that go out to you whenever something topical happens that you should be aware of with your money. Those will be coming out regularly. And of course, we'll be keeping you posted through the annals of Bloke in a Pub. And on that note, we will see you next time.